former senior counselor to Treasury Secretary Scott Bessent, and Diane Swonk, KPMG economic advisor and chief economist, who has regularly briefed the Federal Reserve Board. All right, the poor little frog is going to be subjected to both of you. Joe, right off the bat, I'm very interested in what you heard that indicated to you this is a whole new Fed.
The fact that the statement was so short was very refreshing. The only statement I remember in recent memory that may have been as short was back in March of '03 when we went into Iraq a second time, effectively, or in the Middle East at the time, and it was really short. So one was a short statement. Two, the fact that the last comment in that is they're going to assure price stability. And then three is that Kevin is going to make some changes to the board staff, but it's one of those things where it's going to be substantive over time. He's not going to come in and rabble-rouse and change things. He's very smooth and a politician with a small P. I thought he did a great job. Okay, just want to check the Dow Jones Industrials is down 252. So let's keep an eye on that because we're seeing losses kind of increasing just a bit here. Diane, what about you? What jumped out at you? What began to kind of tickle your ears?
Well, I think it was very important. We saw the unanimous and unambiguous. He emphasized that on the vote, that this Fed, they welcomed him and it was collaborative, that he expects to move forward collaboratively. I think that's important for the institution, and it is important to make change. You've got to get buy-in among everyone around the table, which Kevin is very good at. So I think that really came through. The other part, of course, was I was expecting this very hawkish lean within the dots. Of course, we know that Kevin Warsh did not want to put a dot on the plot, and he did not. But it is important that they signaled that this is what they're concerned about. We are 5 years into inflation. It has been persistent, and signs that inflation was more embedded and more lingering was coming up as the war broke out, but not in response to the war. It actually preceded the conflict in the Middle East. And so even though there's still a great bit of uncertainty regarding that conflict and what happens to energy prices, this is a sort of view by those at the table that there's a more persistent bout of inflation we need to deal with, and we need to derail it. The Fed may not be responsible for all of the inflation that we are enduring, but they are the institution that is responsible for derailing it.
You know, I'm looking at the VIX. It is spiking about 7% at the moment, so the markets are still a little fatutzed about what's going on. But Joe, the dot plot, Diane just brought it up. Of course, this is the projections, I guess, that are submitted by all the Fed members about where they see inflation going. And there was this mystery, by the way, everybody, at around 2 p.m. Eastern when they came out with the statement, first, just the statement. It said that only one of the 19 had declined to issue a dot plot, meaning one declined to give any projection, and everyone was saying which one. Well, here is what Kevin Warsh said he kind of dismissed immediately and made sure that there was no mystery.
This afternoon, you also received the usual summary of economic projections. It's been the practice of this committee for participants to submit these projections, and I have encouraged my colleagues to continue to do so. I, however, have refrained from offering any projections of my own.
He was the one. Joe, is this the first step in killing the dot plot eventually?
No, I don't think they'll kill the dot plot because the Fed, it's hard to be transparent and then pull it back. They could perhaps have scenarios around the dot plot, or even perhaps do the dot plot after the FOMC meeting so as to not have it necessarily dominate the conversation. Markets go back and forth on it. Diane made a very good point, though, about the inflation, the fact that it's been sticky really before the U.S. Went into Iran. And inflation's not in the short term going to fall with the Fed doing nothing. It's been my view that the Fed will have to raise rates at least 100 basis points and set it over the past couple months so people weren't expecting it.
In the past, Joe, that's interesting. In the past, you had said that you felt that there was a real need to cut rates. That has changed. What's behind that?
It changed on February 28th when the U.S. went into Iran and caused tremendous supply chain disruptions along with energy. I hope that the energy markets are correct and that prices will come down as the futures markets are suggesting. But what we've effectively had is a mini COVID. in a sense of supply chain disruptions and prices that are likely to linger. So we're in a world now where the economy was potentially in a disinflationary boom, which is what I had been thinking and telling the Treasury Secretary. But I think now we're just in a boom. But booms by themselves don't necessarily bring about lower inflation. In fact, the only way you're going to get lower inflation over time is for liquidity and credit to come out of the system. That only happens when you've got the Fed raising rates.
Diane, you too believe there will be 2 rate hikes. But here's my question. We are watching oil over just the past 5 sessions drop like a rock, down more than 9%. Certainly leaving the markets yesterday, we had West Texas Intermediate. We can show you what oil is doing at the moment. And it might be higher today, but over the past couple of days, look at this, 13.6% drop just over the past week. So why are you saying that there's underlying inflation completely separate from the spike in oil and gasoline?
Absolutely. And in fact, we saw it in the January and February PCE index on the core super services index. We saw it. It's been there. It's been accelerating. It's been persistent. It preceded the war, and it is continuing even today. We know from the components that go into the PCE index that's going to come out on June 25th for the month of May. That is going to be a very hot number, not just in the overall number with energy components, but in the service sector as well. Some of it exacerbated by the war and the conflict. And I do agree with Joe that there will be some lingering effects, the tail effects of this conflict that we have yet to deal with. Another shoe to drop, and everything from fertilizer to diesel prices in terms of crops with the fall harvest and the food supply as we go into 2027. That's something with a very long tail on it. And we are disrupting supply chains the world over, much of it sort of immune. It goes below the radar screen for most consumers until you actually have to feel it. There is a sort of echoing of the pandemic in the disruptions we've seen in emerging markets. Production in places like Bangladesh is running 40 to 50% on garment production of what it was. We're hearing of rubber glove shortages coming out of the Philippines as they ration. And those scarcities on the ground continue today, even as some ships have made it out of the Strait of Hormuz, and we are still nowhere near the strait being fully open. So we see the futures market anticipating declines in the future and more oil supply in the future, but scarcities on the ground are real today.
Folks, look at the markets here. They are now at their pretty much close to lows of the session. I'm seeing the Dow Jones Industrial is down now 408 points. High of the session was a gain of 281. So there's a pretty broad swing there. S&P now down at the moment by 75 points. NASDAQ not looking good here, down a full percent here, 247-point loss. Russell down 14. Joe, let's look at why. Because the market knows there is very little chance of any rate hike. In fact, no chance at rate cut. And in fact, a much bigger chance just since this morning that there will be rate hikes in September, October, and December. Look at September. I was keeping notes this morning. We came into the morning with a 32% odds of a rate hike. Right now, 50.8%. October, this morning, 40% odds. Now it's nearly 61%. December, this morning, 60% odds. Now it's 77% odds. Do you think that's why the market is increasing the losses here?
100%. But I mean, the markets, as you just alluded to, were just at recent record highs, and we've had a tremendous recovery off of the April lows. And look, Fed's going to raise rates because the economy is healthy. So the fact we don't have rate cuts is probably a good thing, because if you look back earlier in the year when there was fears about the labor market and would it remain weak, labor market's accelerating, labor market's improving. Kevin mentioned that. That's all great news. And therefore, the Fed can take back some of that emergency easing it did last year.
I'm now looking at the VIX, which is also rising. That's Wall Street's fear index. It is now up 10%. This morning, we had the VIX, as I pick up my chicken scratch, because I check all of this, it was up just 1%. So now you can see we do have some fear coming into the market as the S&P continues to fall about 68 points. Diane, Joe, one last question. A year from now, what will we be saying about Kevin Warsh's first Fed year? That he was more dovish than expected or more hawkish than expected? Diane?
I think that he'll be more hawkish than many expected. I think he's committed to price stability. Once you get inside the Fed, the one thing to make the biggest mistake you could possibly make when you've already got 5 years of inflation behind you is to not deal with it. And at the end of the day, he wants to be remembered for derailing inflation, not for stoking a more persistent bout of inflation.
Joe, they're not going to make the president happy. He has been very clear.
It's going to be a very short honeymoon, but Kevin Warsh should be the Fed chair longer than the president will remain in the office, and he's going to do what's right for the institution, what's right for the economy, and as Diane was alluding to, they're going to follow the data. And if the data dictates they need to raise rates, they're going to raise rates.
And he had said during his testimony he would be independent of the White House. We shall see. Diane, Joe, great to have you both.